discussed earlier on the program. We have what seems like a pretty strong jobs market, then disappointing inflation data, and tomorrow maybe a disappointing GDP number again. Where do you fall? Strong or not strong?
Not strong. The key numbers are going to be tomorrow, and everyone expects that the growth rate for the fourth quarter is going to be about 2%, which is a downward revision from the earlier version. And it may even be less than that. To be sure, the jobs growth have been very significant, but if you look at the numerator of output per hour, which is gross domestic product, and the denominator, which is hours, which are very large, we're getting a weakened evidence of productivity. And that is the key statistic which tells how the economy is functioning.
In fact, Greg Ip just told us he also was concerned about weak productivity growth. The weakest, he said, since the 1970s. It means less slack for the Fed, and it means for the U.S. a smaller economy in the long run.
Well, it's a smaller economy now. And it is basically because of the fact that productivity is crucial for a market economy. And what's been happening in the United States is, for a lot of reasons, which I can get into, which I've written in a book, or a couple of books, gross domestic savings has been declining in this country for years. And it's fundamentally caused by, the data show, the very large surge in essentially the bipartisan push on entitlement programs.
So entitlements are crowding out investment in this country, and that's what's hurting our productivity?
They're crowding out savings, and because the savings are the critical aspect in investment, the rest incidentally is borrowing from abroad. It's crowding out capital investment, and capital investment is key to productivity growth. That has slowed down quite dramatically, and productivity has followed right along.
So what do we do? Is the Fed somehow at fault in the middle of all this, as was reflected in the tenor of the hearings this week, in the move to audit the Fed and do all of these things? Is the Fed the culprit?
No. The Fed basically is doing a number of things, some which works and some which don't. One which has worked and is working is the significant increase in the amount of purchases of securities on the balance sheet, not to induce lending on the part of the private sector, but to push rates down. Because if you take a look at the balance sheet of the Fed, they have bought up very large chunks of Treasury notes and mortgage-backed securities, suppressed the real long-term interest rates, and that arbitraged into a very significant increase, or I should say a rising pattern in the way of price-earnings ratios, capitalization ratios in real estate, so all income-producing assets.
That's what's behind this NASDAQ, if you want to call it, move to 5,000 back to those new highs?
Yes.
So the Fed is at fault then?
Well, it's not at fault. It's actually, I presume one would say it's good, not bad.
Except we've seen how this ends before. I guess that's why there's all this concern, is that we've seen what has happened in the past when asset prices have shot up and there have been low interest rates. And does this all potentially end as badly as it did the last couple ago?
Well, it depends. Right at the moment, equity premiums, which is a measure of the extent to which common stock is required to have a particular yield over and above riskless bonds, that number is actually average. It was extraordinarily high right at the edge of the crisis, the highest in 50 years. It's come down a good deal as the market has gone up, but we're not yet there in a position where it's crisis. However, the real issue here is going to be when real interest rates start to move up. Remember, it is real interest rates plus the equity premium, which is the total return on common stock.
And speaking of those rates, if we see a situation like we're in now, where the market's anticipating the Fed will raise rates, but longer-term rates, the 10-year rates and the 30 rates, keep falling, is that your conundrum coming back here again?
No, it's not a conundrum. It's an indication of how weak the overall global economy is. And a goodly part of what's going on remember, European rates are lower than ours. Portuguese rates are lower than the U.S. rates. Now that's
what do you think about that?
Well, it's induced by the fact that since it can't be a problem of liquidity, we don't actually have liquidity, but we have the potential for very large liquidity. It has got to be that effective demand is extraordinarily weak. In fact, the way I measure it, it's probably tantamount to what we saw in the latest stages of the Great Depression.
That's how weak you think the global economy is right now?
Well, it's not anywhere near what the problems were back then, but we haven't seen anything like that since then.
Is that a policy response then? Is it something central banks who have cut interest rates all over the map lately are supposed to respond to? Or is there something very, very different that ought to be done here?
It's fundamentally the fiscal issues. It's the fact that we are absorbing all of the capital investment, not all of it, but a substantial amount of the capital investment from the economy. If you look at the United States by itself, we've had virtually no pickup since we crashed in 2008. There have been lots of false dawns. I mean, the market goes up, down, up and down and down.
Well, it's up. The stock market's up pretty significantly.
Stock market is straight up, but the economy is not.
Right.
And the basic reason why the economy is not, if you just look at the data, is a shortfall in long-term capital investment. If you took structures and long-term equipment out of the GDP, it would be having fairly normal relative to the usual type of rises that occur.
So that's the culprit. Yeah.
Almost all the problem is in long-term assets. In fact, technically, assets in excess of 20 years. And to me, you can pick this up very obviously. You can pick up what is happening by looking, for example, at non-financial corporations who have had very significant liquid cash flow. The amount of that liquid cash flow they choose to invest in illiquid long-term assets is at a very low level. And in fact, in 2009, 2010, it got to the lowest levels since 1940.
And there you go.
And that's where the issue lies. It's all confidence. It's risk. And I know what happens because I've been, before I was at the Fed, I used to be involved in capital investment projects for corporations. And what we're looking at is the fact of very wide variance of expectations on long-term projects because nobody knows what's going to happen out there. We're dealing not only with uncertain tax rates, which you can't tell because of the size of the deficit, but, well, we've got global warming, we've got all sorts of things going on in the Middle East which don't seem to be simmering down, so that nobody wants to invest in the very long term.
Important point.
And that's where the biggest weakness, in fact, it's where the weakness in the economy is in the United States, it's where the weakness in the Eurozone is, and it's essentially pretty much globally. And it is showing up in a very significant spread opening up between the U.S. 5-year note and the 30-year bond. That extraordinary rise in the discount rate as you go up year 5, 6, 7, 8, 9, it is rising, and that is saying that nobody wants to invest in the very long term.
We have to go, but I just want to quickly ask you for your reaction to the acrimony, if you will, over Janet Yellen appearing this week to testify at the Fed. Just from your own personal experience testifying before Congress, is it always acrimonious, or has something changed in your experience since your chairmanship?
It's always acrimonious.
Always.